Now speaking, Jake Spiring, General Manager, Investor Relations. Thank you, Katie. Welcome to Chevron's second quarter 2023 earnings conference call and webcast. Our Chairman and CEO, Mike Wirth, and CFO, Pierre Breba, are on the call with me today. We will refer to the slides and prepared remarks that are available on Chevron's website. This presentation contains estimates, projections, and other forward-looking statements. Chevron's second quarter 2023 earnings report shows a strong performance in upstream operations, with production up 4% year-over-year. The company also. Now speaking, Mike Wirth, Chairman and Chief Executive Officer. Thank you, Jake. Our second quarter performance highlights included return on capital employed greater than 12% for the 8th consecutive quarter and a quarterly record in shareholder distributions of more than $7 billion. At TCO, we're making good progress with commissioning and pre-startup activities, including introducing fuel gas to new facilities. In the third quarter, we expect mechanical completion for the Future Growth Project and to complete a major turnaround. Cost and schedule guidance is unchanged. Conversion of the field from high pressure to low pressure is expected to begin late this year, and FGP is on track to start up by mid-next year. We have unused contingency which gives us confidence that we'll complete the project within the total budget. After completion, TCO is expected to deliver production greater than 1 million barrels of oil equivalent per day and generate about $5 billion of free cash flow, Chevron share at $60 Brent in 2025. Chevron's Permian production set another record in the second quarter, about 5% above the previous quarterly high. We expect next quarter's production to be roughly flat before growing again in the fourth quarter, on track with our full-year guidance. Early 2023 well performance in our company-operated assets in all three areas is consistent with our plans. In New Mexico, we've put on production at 10 wells. Before year-end, we expect to pop an additional 30 wells with higher expected production rates. We have identified well over 6,000 economic net well locations that support a plateau greater than 1 million barrels per day through the end of next decade. Our deep resource inventory and advantaged royalty position allow us to optimize our development plans for high returns, incorporating learnings and technology improvements, as we expect to deliver strong free cash flow for years to come. In the deepwater Gulf of Mexico, the floating production unit at Anchor is on location and the project remains on track for first oil next year. We continue to build on our exploration success and were awarded the highest number of blocks in the most recent lease round. In the Eastern Med, our Aphrodite appraisal well in Cyprus met our expectations, and we've submitted a development concept to the government. At Leviathan, we're expanding pipeline capacity to nearly 1.4 BCF per day. We expect to close our acquisition of PDC Energy in August after their shareholder vote next week. Now speaking, Pierre Breba, Chief Financial Officer. Chevron reported record cash returns to shareholders this quarter, while also investing within their Capex budget and paying down debt. Working capital lowered cash flow primarily due to true-up tax payments outside the U.S. Chevron's net debt ratio ended the quarter at 7%, significantly below the low end of their guidance range. Adjusted second quarter earnings were down $5.6 billion versus the same quarter last year, mainly due to lower realizations in the upstream sector and lower refining margins in the downstream sector. Compared with last quarter, adjusted earnings were down $900 million. Oil equivalent production was down about 20,000 barrels per day from last quarter, primarily due to planned turnarounds and downtime associated with the Canadian wildfires. Chevron plans to resume buybacks at the $17.5 billion annual rate after they close the acquisition in August, and do not expect a dividend from TCO until the fourth quarter. Full-year affiliate dividends are expected to be near the low end of their guidance. J.P. Morgan Chase & Company analyst John Royal inquired, what factors have caused production to move from the midpoint of guidance to the lower end? Mike Wirth replied, we expect to be at the lower end of our guidance due to two unexpected events, fires in Canada that caused us to evacuate our operations on a precautionary basis, and an incident with our FPSO in Thailand that has taken it off station for the foreseeable future. This has resulted in a net loss of 10,000 to 11,000 barrels a day. J.P. Morgan Chase & Company analyst John Royal inquired, what inning are you in for optimizing single bench developments in New Mexico? Mike Wirth replied, the data from the New Mexico type curve we showed in the second quarter only represents 10 pops, with only 7 having enough data to make it into the chart. We expect 30 more pops in the second half of this year, which will provide a more representative sample. Additionally, some facility constraints have limited full productivity from the wells we did pop, and the rest of the program is in a different part of the Delaware where we anticipate higher productivity. So, it's important to bear in mind that the data set is thin and more data is coming in the second half of the year. Morgan Stanley analyst Devin McDermott inquired, could you please discuss the mix trend you're seeing in the Permian and how you expect it to evolve over time? Mike Wirth replied, yes, Devin. We are still drilling primary benches to maximize the oil cut. Our production is currently split 50% oil, 25% NGLs, and 25% gas. We have our own long-term views on prices and markets to ensure the best returns. The gas/oil ratio has been relatively stable for a few years and we don't anticipate much change. Across our portfolio, the 50/25/25 split is a good representation. Morgan Stanley analyst Devin McDermott inquired, "What is your outlook for TCO production over the next few quarters and into 2024? Mike Veerth replied, "The headline is no change to cost and schedule. We made good progress in Q2 with 98% project completion and commissioning 2/3 complete. We achieved mechanical completion of the 3 GI facilities and got fuel gas into the flare system, which is important for FTP startup. In Q3, we expect full mechanical completion of the Future Growth project and a turnaround at one of the KTLs. This will enable us to begin conversion of metering stations from high pressure to low pressure, which will take 10 to 12 months. There will be 2 more turnarounds next year, at SGI and another KTL, as part of a choreographed sequence of activities to bring the field to 1 million barrels a day by 2025. Goldman Sachs analyst Neil Mehta inquired, "Can you provide an update on the free cash flow inflection in 2024 and how it will affect dividends?" Pierre Braber replied, "We've been guiding to a clean year in 2025 with $5 billion of free cash flow and $60 Brent. We've seen a decrease in Capex from $3 to $4 billion to $1.5 billion this year, and we expect to see a bigger dividend in the fourth quarter than we saw in 2Q. TCO has good price sensitivity, so if commodity prices reach 70 to 80%, the cash flow will be even stronger. We expect to see a release of some of the surplus cash held on the balance sheet over the next couple of years as we head into 2025. Goldman Sachs analyst Neil Mehta inquired, "What is the return of capital you are targeting in a reasonable commodity price environment?" Pierre Braber replied, "The buyback range is tied to our upside/downside cases from our investor day, which is roughly $10 billion to $20 billion. Our downside case projects a price of $50 over the next few years, while our upside case is close to what we're seeing now, averaging around $85 and trending down to $70. We chose to do a buyback of $17.5 billion, which is close to the top end of the range, as a signal that we feel good about the commodity cycle. We could have done a larger buyback, but we want to be steady across the cycle and not procyclical." Mike Veerth replied, "Yes, Neil. Our net debt remains very low and we are confident that we can gear back up to our target range in order to sustain our share repurchase program." Evercore IC analyst Stephen Richardson inquired, "Mike, could you discuss the KISS business and why build versus buy is the better choice for Chevron? Could you also provide an update on Buyubend?" Mike Veerth replied, "We'll do both build and buy in new energies, particularly in renewable fuels. We've built a business and acquired Renewable Energy Group. The Denbury transaction was anticipated by the market. In KISS, we look for areas with good geology, near concentrated emissions and policy support. We have 140,000 acres of permanent CO2 pore space in the Gulf Coast, with storage potential of over 1 billion metric tons. We're drilling strat wells in the offshore and onshore acreage to further characterize the subsurface. We're in negotiations with potential customers and working on the other pieces needed, such as well injection permits and midstream assets. We're putting all the pieces together for a phased development and we'll report more. We'll build organically and do inorganic acquisitions where it makes sense." RBC Capital Markets analyst Biraj Borkhataria inquired, "Can you discuss portfolio concentration and how you think about portfolio diversity given that roughly half of your free cash flow comes from the Permian plus TCO?" Mike Veerth replied, "We've been very focused on cleaning up our portfolio and making sure that we have assets that are material, that have scale, and that are long-lived." Pierre Braber replied, "Our business is built to generate strong free cash flow, even at lower oil prices. We have guided to 10% annual free cash flow growth from our businesses, and this has enabled us to grow our dividend at double the rate of our closest peer and much higher than others. We also have a buyback program that is nearly 6% of our shares outstanding annually. Our current break-even point, adjusted for working capital, is lower than it has been in the last 4 quarters due to strong refining margins. This should give investors confidence in our ability to continue to grow the dividend and maintain buybacks at high rates." RBC Capital Markets analyst Biraj Borkhataria inquired, "What is your strategy for integrating U.S. gas into global markets, and how do you weigh the benefits of owning liquefaction versus being an offtaker?" Mike Veerth replied, "Our strategy is to focus on areas where we can create a differentiated value proposition and drive higher returns. We look for opportunities to invest in remote gas assets where we can be involved in the entire value chain, or to offtake gas from midstream assets where we can benefit from reliable operations and good partners. We vet our partners carefully to ensure that we are able to drive high returns and create a differentiated value proposition." Wolfe Research analyst Sam Margolin inquired, "What is your outlook for the cash balance in the second half of the year? Pierre Braber replied, the direction of our cash balance depends on commodity prices, margins, and other factors. We've been clear that we don't want to hold surplus cash, so we're returning it to shareholders in the form of a growing dividend and buyback program. We need about $5 billion to support operations, and we have access to lots of liquidity. We're guiding toward a net debt below the low end of our guidance range. Working capital tends to average out over zero, but there are timing effects like taxes due that we plan for. Jake Spiring replied, Sam, we are not expecting a dividend in the third quarter. We have guided to a TCO dividend in the fourth quarter. Wolf Research analyst Sam Margolin inquired, what strategies are in place to ensure Chevron is investing in the highest return areas of low-carbon development and carbon capture? Mike Virth replied, yes, our commitment to driving higher returns and lower carbon is a priority across the entire leadership team. We focus on leveraging our unique capabilities, assets, value chains, and customers to create sustainable competitive advantage in new energy businesses. We have a profitable renewable fuels business that we expect to expand next year with the Geismar expansion. We also recently acquired a small company with interesting feedstock technology. Additionally, we are investing in carbon capture and storage, hydrogen, and other technologies, taking advantage of incentives like the IRA to develop business models. TD Cowen analyst Jason Gableman inquired, Pierre, has Capex in the Permian deviated from the $4 billion budget discussed at Analyst Day? What percentage of Permian inventory locations would you categorize as Tier 1 over the 5-year plan? Mike Virth replied, Permian Capex is up this year due to improved drilling and completion performance, longer lead times on critical elements, and increased facility scope for water handling. We haven't broken our portfolio into tiers, but we have more than 6,000 locations that are economic based on today's technology and price view. As we get closer to that window, we may see a different price environment and technology which could allow that number to grow even further. TD Cowen analyst Jason Gableman inquired, can you quantify the impact of maintenance activities on production over the next 4 quarters? Pierre Braber replied, we provide quarterly guidance on TCO, which is included in our third quarter guidance. We also provide annual guidance that takes into account all the moving parts. We are committed to providing this guidance on a regular basis. Societe Generale analyst Irene Himona inquired, what were the performance of your chemicals affiliates in Q2 and what do you expect for refining margins in the second half of the year? Mike Virth replied, the chemicals business is cyclical, and we're currently in a period of extended supply due to new build facilities. This has weighed on margins in the olefins chain, and we expect this to continue in the short term. However, demand is expected to grow in the mid-decade and beyond, which should bring supply and demand into better balance and result in margin recovery. Mike Virth replied, refining margins have come off from the strong levels seen last year due to new capacity coming online. West Coast margins have held up better than other regions due to its isolated market. Demand for gasoline and jet fuel is strong, while diesel demand has flattened out. We expect refining margins for the second half of this year to be as good as the first half. Societe Generale analyst Irene Himona inquired, could you please provide more detail on the impact of the new regulations on your business? Is there any further exploration of options for Leviathan, such as FLNG? Mike Virth replied, we are actively evaluating options for the next expansion of Leviathan, with a concept select plan for the end of this year. One of the concepts we are considering is floating LNG. Piper Sandler analyst Ryan Todd inquired, what have you seen in terms of well performance this year, particularly regarding spacing, single versus multi-bench approaches? Mike Virth replied, the performance of our portfolio is in line with our expectations and what we outlined at our Investor Day earlier this year. We've seen some infrastructure and third-party constraints in New Mexico, as well as other parts of our portfolio. As we continue to adjust our development strategy, such as well spacing, profit loading, and well length, these changes will be reflected in our curves. Production is important, but we're not optimizing for it. We're optimizing for returns, which includes fluid mix, and capital investments. All of these factors are important in driving returns, even though they may not be visible when looking at production alone. Piper Sandler analyst Ryan Todd inquired, what measures have you taken to mitigate cost escalation in your Gulf of Mexico deepwater projects over the next few years? Pierre Braber replied, yeah, those projects were contracted at a different time, so they reflect mostly locked-in rates. The procurements are well behind us and the projects are pretty far along, so we won't be exposed to higher rig rates for existing major capital projects. Mike Virth replied, we entered the year with 3 rigs under contract, which were contracted in a different environment. Scotiabank analyst Paul Cheng inquired, what is the timeline for submitting a development plan in Cyprus discovery? What is the preliminary design and scale of the development? When can we expect to see the first oil? What is your update on shale oil development in Argentina? Mike Virth replied, Paul, we're pleased with the outcome of the recent appraisal well in Cyprus. We've submitted a development plan to the government for approval, which involves a capital-efficient way to take the gas to market via subsea tiebacks to existing infrastructure. This is pending government approval, and if successful, we could enter FEED later this year. It's too early to discuss first gas timeline. In Argentina, we remain positive on the resource. There's an election coming up and macroeconomic challenges, but we like the block, particularly El Trapil, where we're doing more development work with increased capital. We'll discuss this further at Investor Day. It's part of our growth story. Bank of America Merrill Lynch analyst Doug Leggate inquired, Pierre, what is the ratability of the Permian wells over the next 5 years? Pierre Braber replied, the coup pops is 200, but when you factor in the non-op and royalty, it's closer to 300. Our well inventory is expected to remain steady at 2,200 over the next 5 years. This includes all activity, and the POP data was only for company-operated wells. So, there is some increase, but not as much as it appears. To get an accurate comparison, you need to make sure you're comparing apples to apples. Bank of America Merrill Lynch analyst Doug Leggate inquired, Pierre, what is the annual rate of the deal? Pierre Braber replied, yes, as we increase our activity levels, we are becoming more efficient and our partners are too. We anticipate that our operations will be running smoothly once we reach our full capacity. Mike Veerth replied, Doug, quarter to quarter there can be some variability in our performance. We saw this earlier this year with a surge in the first quarter and a plateau in the second. However, on an annual basis, we expect our performance to remain consistent. Bank of America Merrill Lynch analyst Doug Leggate inquired, what are your options for Tengiz post-2027 and what is the production profile post-2030? Mike Veerth replied, the concession is a decade away, and our focus is on delivering the project. We'll be in discussions with the government about extending the concession, based on reservoir performance and production opportunities. We want to create value for both parties, and have walked away from concessions where it didn't work for us, such as Indonesia and Thailand. We've extended concessions where it did, such as Angola. Our priority is executing the project and delivering FTP. Wells Fargo Securities analyst Roger Reed inquired, what are the opportunities you plan to pursue with your extended tenure? Mike Veerth replied, Roger, it's been a tumultuous start to my tenure with restructuring, the pandemic, oil price fluctuations, geopolitical noise, and ESG issues. We've also made 3 acquisitions, one of which is yet to close. Despite all this, we've delivered strong results and maintained consistent shareholder distributions. I'm looking forward to smoother waters and continuing to drive higher returns and lower carbon for our shareholders. Wells Fargo Securities analyst Roger Reed inquired, what factors contributed to the improved oil realizations in Q2 compared to Q1? Pierre Braber replied, Roger, our oil realizations have been strong and our natural gas realizations have been robust. We had favorable timing in the first quarter, which may make international gas appear weaker when compared quarter on quarter. If you have any further questions about liquids, please follow up with Jake after the call. Jake Spiring replied, thanks, we appreciate everyone's time and interest in Chevron. Stay safe and healthy.